Question 1. To address the challenge of a mid-sized municipality in Ontario, Canada, seeking to finance a new public infrastructure project, a municipal securities representative is tasked with advising on the most suitable primary financing method. The municipality has a stable but limited tax base and a desire for a financing structure that minimizes immediate financial burden while ensuring long-term fiscal responsibility. What is the most appropriate course of action for the representative? Option A. Advise the municipality to explore private placement options with a single financial institution, as this can often lead to faster approvals and potentially more flexible terms compared to public offerings. Option B. Immediately recommend the issuance of general obligation bonds, as this is a common and straightforward method for municipalities to raise capital for public projects, and it is likely to be well understood by the municipality's finance department. Option C. Suggests that the municipality prioritize a financing method that offers the lowest initial interest rate, even if it involves more restrictive covenants or a shorter repayment term, to alleviate immediate budget pressures. Option D. Conduct a comprehensive review of the municipality's financial health, existing debt obligations, and the specific requirements of the infrastructure project. Then present a balanced analysis of various primary financing methods, including general obligation bonds, revenue bonds, and potentially lease financings, detailing the implications of each on the municipality's credit rating, debt capacity, and operational flexibility, allowing the municipality to make an informed decision. The correct answer is D. Conduct a comprehensive review of the municipality's financial health, existing debt obligations, and the specific requirements of the infrastructure project. Then present a balanced analysis of various primary financing methods, including general obligation bonds, revenue bonds, and potentially lease financings, detailing the implications of each on the municipality's credit rating, debt capacity, and operational flexibility, allowing the municipality to make an informed decision. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a municipal securities representative to understand the nuances of different primary financing methods and their suitability for a specific issuer's needs, while also adhering to regulatory requirements for disclosure and fair dealing. The representative must balance the issuer's desire for efficient fundraising with the need to ensure the financing method chosen is appropriate, legally sound, and transparent to potential investors. Misunderstanding or misrepresenting these methods can lead to regulatory violations and harm to both the issuer and investors. Correct approach analysis. The best approach involves a thorough understanding of the issuer's financial situation, capital needs, and existing debt structure, followed by a detailed explanation of the advantages and disadvantages of various primary financing methods, such as general obligation bonds, revenue bonds, and lease financings, in the context of the issuer's specific circumstances. This includes discussing the implications of each method on the issuer's creditworthiness, tax status, and operational flexibility. The representative must then present these options neutrally, allowing the issuer to make an informed decision based on comprehensive information and expert guidance, in compliance with MSRB Rule G17 regarding fair dealing. Incorrect approaches analysis. Recommending a financing method solely based on the issuer's stated preference without a comprehensive analysis of their financial health, and the implications of that method would be a failure of due diligence and fair dealing. This approach prioritizes the issuer's immediate desire over a prudent, long-term financial strategy, and neglects the representative's obligation to provide informed advice. Suggesting a financing method that is known to be more complex or costly for the issuer, without a clear justification of superior benefits, could be seen as a conflict of interest or a failure to act in the issuer's best interest, potentially violating MSRB Rule G17. Presenting only one financing option, even if seemingly beneficial, without exploring alternatives, limits the issuer's ability to make the most advantageous choice and fails to meet the standard of providing a full and fair picture of available options. Professional reasoning. Professionals should always begin by gathering all relevant information about the issuer's financial condition and objectives. They should then educate the issuer on the spectrum of available primary financing methods, detailing the pros and cons of each in relation to the issuer's unique situation. Transparency and a commitment to the issuer's best interests are paramount, ensuring that the final decision is well-informed and compliant with all applicable regulations. Question 2. Examination of the data shows that a deceased client's estate in Ontario, Canada, holds municipal securities. The executor of the estate wishes to transfer these securities to the beneficiaries. What is the most appropriate initial step for the municipal securities representative to take to facilitate this transfer? Option A. Rely solely on the executor's verbal confirmation of the security's ownership status without independent verification. Option B. Assume all municipal securities are held in fully registered form and initiate a physical certificate transfer process. Option C. Advise the executor to sell all municipal securities and distribute the cash proceeds to the beneficiaries. Option D. Ascertain the specific form of ownership, fully registered or book entry only, for each municipal security holding, and then proceed with the appropriate transfer procedure based on that determination. The correct answer is D. Ascertain the specific form of ownership, fully registered or book entry only, for each municipal security holding, and then proceed with the appropriate transfer procedure based on that determination. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities representative in Ontario, Canada, to navigate the practical implications of different ownership forms for municipal securities, specifically fully registered versus book entry only, in the context of a client's estate. The challenge lies in accurately identifying the most appropriate method for transferring ownership to beneficiaries, ensuring compliance with both securities regulations and estate law, and prioritizing the client's stated wishes and the efficiency of the transfer process. Misinterpreting the ownership form or the transfer procedures could lead to delays, increased costs, and potential regulatory breaches. Correct approach analysis. The best professional approach involves first confirming the exact form of ownership for the municipal securities held within the estate. If the securities are confirmed to be in fully registered form, the representative should guide the executor through the process of obtaining a physical certificate transfer, or, if applicable and permissible by the issuer, facilitating a direct registration transfer to the beneficiaries' names. If the securities are in book entry-only form, the representative must understand that ownership is recorded electronically. In this case, the representative should work with the executor and the relevant depository, e.g., CDS, to facilitate the transfer of beneficial ownership to the beneficiaries' accounts, typically by initiating a transfer request through the executor's brokerage account or directly with the depository if authorized. This approach is correct because it directly addresses the legal and practical requirements of transferring ownership based on the specific form of the security, ensuring compliance with the Ontario Securities Commission (OSC) regulations regarding the handling of client assets and the proper transfer of securities. It prioritizes accuracy and adherence to the established procedures for each ownership type. Incorrect approach is analysis. One incorrect approach would be to assume all municipal securities are transferable in the same manner, regardless of their ownership form, and to proceed with a generic transfer process without verifying if the securities are fully registered or book entry only. This is professionally unacceptable because it ignores the fundamental differences in how ownership is recorded and transferred for each form. For fully registered securities, a physical transfer or direct registration is required, while book entry-only securities rely on electronic record keeping. Failing to distinguish between these can lead to an invalid transfer attempt, causing significant delays and potential disputes. Another incorrect approach would be to advise the executor to simply liquidate all the municipal securities and distribute the cash proceeds to the beneficiaries without first exploring the possibility of transferring the securities directly. This is professionally unacceptable because it bypasses the client's potential intent to pass on the actual securities and may not be the most tax-efficient or desirable outcome for the beneficiaries. Furthermore, it fails to acknowledge the representative's duty to facilitate the transfer of assets as they are, unless otherwise directed or necessitated by circumstances, and to act in the best interests of the estate and its beneficiaries, as guided by OSC regulations. A further incorrect approach would be to rely solely on the executor's understanding of the securities ownership form without independent verification. While executors have a fiduciary duty, they may not possess the specialized knowledge of securities ownership structures. This approach is professionally unacceptable because it outsources the critical verification step, potentially leading to errors in the transfer process and a failure to meet the representative's obligation to ensure accurate and compliant handling of securities transactions. Professional reasoning. Professionals should adopt a systematic approach. First, identify the specific type of security and its ownership form, fully registered or book entry only. Second, consult the relevant issuer documentation, or depository rules, for the precise transfer procedures applicable to that ownership form. Third, communicate clearly with the executor, explaining the options and requirements for transferring the securities to the beneficiaries. Fourth, execute the transfer process meticulously, ensuring all necessary documentation is completed accurately and submitted to the appropriate parties. This structured decision-making process, grounded in regulatory compliance and client-centric service, is essential for managing estate-related securities transfers effectively and ethically in Ontario. Question 3. Research into the financing of a new public transit infrastructure project in Toronto, Ontario, has revealed that the municipal securities issued to fund this initiative are intended to be repaid from the operational income generated by the transit system itself. As a representative advising potential investors, which of the following accurately describes the general source of payment for these municipal securities? Option A. Generally payable from a combination of project revenues and general municipal taxes. Option B. Generally payable from future, unspecified provincial government grants. Option C. Generally payable from project revenues. Option D. Generally payable from general municipal taxes. Correct answer is C. Generally payable from project revenues. Explanation. This scenario is professionally challenging because it requires a deep understanding of the specific revenue streams that can legally back municipal securities in Ontario, Canada, and the implications of misrepresenting these sources to potential investors. A failure to accurately identify and communicate the source of payment can lead to significant regulatory action, investor distrust, and financial repercussions for the issuer and the dealer. Careful judgment is required to ensure compliance with Ontario's securities laws and fair dealing principles. The best professional approach involves accurately identifying and disclosing that the municipal securities are generally payable from project revenues. This aligns with the fundamental principle of municipal finance, where the success and repayment of such securities are directly tied to the operational income and financial performance of the specific project or enterprise they finance. Ontario securities regulations emphasize transparency and the accurate representation of material facts, including the source of repayment, to enable informed investment decisions. This approach ensures compliance with the municipal securities representative exam's focus on the source of payment and upholds the duty of fair dealing owed to investors. An incorrect approach involves stating that the securities are payable from general municipal taxes. While some municipal debt is backed by general tax revenues, project revenue bonds are specifically designed to be repaid from the income generated by the project itself. Misrepresenting this can mislead investors about the risk profile and the underlying security of the investment, potentially violating Ontario's securities laws regarding misrepresentation and omission of material facts. Another incorrect approach is to claim the securities are payable from a combination of project revenues and general municipal taxes without specific authorization or a clear legal structure that supports such a dual pledge. This ambiguity can obscure the true source of repayment and create confusion for investors, potentially leading to a breach of disclosure obligations. A further incorrect approach is to suggest the securities are payable from future, unspecified provincial government grants. While grants can sometimes supplement project funding, they are generally not considered the primary or legally binding source of repayment for project revenue bonds. Relying on such an uncertain source without clear legal backing and disclosure would be a significant misrepresentation. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves thoroughly researching the specific bond indenture and offering documents to understand the exact legal provisions governing the source of payment. Any ambiguity or lack of clarity should be addressed through further inquiry with the issuer or legal counsel before making any representations to investors. The principle of know your product is paramount, and this extends to a precise understanding of the securities repayment structure. Question 4. In the state of New York, when a municipal securities representative is considering recommending a new municipal bond issuance to a client, which approach would be the most prudent and compliant method to ensure the security meets depository eligibility requirements? Option A. Rely solely on the issuer's statement that the security is tradable without further investigation into its deposit status. Option B. Assume that all municipal securities issued by a New York municipality are automatically eligible for deposit. Option C. Delegate the entire responsibility of confirming depository eligibility to the firm's back-office operations without independent verification. Option D. Proactively verify that the municipal security is eligible for deposit with a DTC-eligible clearing agency. The correct answer is D. Proactively verify that the municipal security is eligible for deposit with a DTC-eligible clearing agency. Explanation. Scenario analysis. This scenario presents a professional challenge because a municipal securities representative must ensure that any security they recommend or facilitate the purchase of meets the stringent depository eligibility requirements mandated by FINRA rules for municipal securities. Failure to do so can lead to significant regulatory penalties, reputational damage, and potential financial harm to clients. The representative must navigate the complexities of depository rules to uphold their duty of care and ensure compliance. Correct approach analysis. The best professional approach involves proactively verifying that the municipal security in question is eligible for deposit with a depository trust company, DTC, eligible clearing agency. This means confirming that the issuer has made arrangements for the security to be held in book entry form, and that the security meets all other DTC eligibility criteria. This approach is correct because FINRA Rule 4200 A. 10 defines a municipal security to include securities issued by a state or municipality, and the operational mechanics of trading and clearing. These securities heavily rely on their eligibility for deposit with a DTC-eligible clearing agency. Ensuring this eligibility is a fundamental prerequisite for the efficient and compliant trading of municipal securities, directly impacting the ability to settle transactions and protect client interests. Incorrect approaches analysis. One incorrect approach is to assume that all municipal securities are automatically eligible for deposit simply because they are issued by a municipality. This assumption overlooks the specific operational requirements and agreements necessary for a security to be DTC eligible. Without explicit confirmation, the representative risks recommending or facilitating the purchase of a security that cannot be properly cleared and settled, leading to potential trade failures and regulatory violations. Another incorrect approach is to rely solely on the issuer's representation that the security is tradable without verifying its specific depository eligibility. While an issuer may intend for a security to be traded, this does not automatically guarantee it meets the technical requirements for deposit with a DTC-eligible clearing agency. This approach fails to address the critical operational aspect of clearing and settlement, which is essential for compliant trading. A further incorrect approach is to delegate the responsibility of verifying depository eligibility entirely to the back office or clearing department without independent confirmation. While these departments play a crucial role, the registered representative remains ultimately responsible for ensuring that the securities they handle are compliant with all applicable rules, including depository eligibility. This abdication of responsibility can lead to oversight and non-compliance. Professional reasoning. Professionals should adopt a proactive and diligent approach to verifying depository eligibility. This involves 1. Understanding the definition of a municipal security and its trading implications. 2. Familiarizing oneself with FINRA rules pertaining to municipal securities trading and clearing. 3. Consulting official sources or DTC's eligibility lists to confirm a specific security status. 4. Documenting the verification process to demonstrate due diligence. 5. Prioritizing client protection and regulatory compliance in all transactions. Question 5. Governance review demonstrates that a client in California is seeking to invest in municipal bonds that offer a stable income stream and are backed by essential public services. The client has expressed interest in a new revenue bond issuance by a large, nonprofit hospital system in California, which plans to use the proceeds to expand its facilities and upgrade medical equipment. What is the most prudent course of action for a Series 52 Municipal Securities representative? Option A. Proceed with the recommendation after a brief discussion with the hospital's chief financial officer, accepting their assurance of the bond's financial soundness. Option B. Conduct a thorough analysis of the hospital system's financial statements, debt service coverage ratios, operational performance, and the specific terms and covenants of the revenue bond issuance, while also considering the economic and demographic factors impacting the hospital's service area to determine suitability for the client. Option C. Recommend the revenue bonds based on the essential nature of hospital services and the tax-exempt status of municipal bonds, assuming the client's need for stable income. Option D. Advise the client to invest in the bonds, emphasizing the potential for capital appreciation due to facility expansion and the general stability of healthcare demand. The correct answer is B. Conduct a thorough analysis of the hospital system's financial statements, debt service coverage ratios, operational performance, and the specific terms and covenants of the revenue bond issuance, while also considering the economic and demographic factors impacting the hospital's service area to determine suitability for the client. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities representative to navigate the complexities of a revenue bond issuance for a public hospital system in California. The representative must ensure that their recommendation aligns with the client's investment objectives and risk tolerance, while also adhering to the specific disclosure requirements and suitability standards applicable to municipal securities under California law and FINRA regulations. The potential for conflicts of interest, the need for thorough due diligence, and the importance of clear, accurate communication are paramount. Correct approach analysis. The best professional practice involves a comprehensive assessment of the hospital system's financial health, operational stability, and the specific terms of the proposed revenue bond issuance. This includes scrutinizing the hospital's historical financial performance, projected revenues, debt service coverage ratios, and any covenants or restrictions associated with the bonds. Furthermore, understanding the economic and demographic factors influencing the hospital's service area is crucial. This approach ensures that the recommendation is based on a thorough understanding of the security's creditworthiness and its suitability for the client, aligning with FINRA Rule 2110, Standards of Commercial Honor and Principles of Trade, and the Municipal Securities Rulemaking Board, MSRB, Rule G17, Disclosure of Material Information. Incorrect approach is analysis. Recommending the bonds solely based on the perceived essential nature of hospital services, without a detailed financial and credit analysis, represents a failure to conduct adequate due diligence. This overlooks the specific risks associated with revenue bonds, which are dependent on the revenue-generating capacity of the issuer. Similarly, focusing only on the tax-exempt status of the bonds without evaluating the underlying credit quality demonstrates a disregard for the client's investment objectives and risk tolerance, potentially violating suitability obligations. Finally, relying on information provided by the issuer without independent verification or further investigation into potential risks, such as changes in healthcare regulations or competitive pressures, is a breach of professional responsibility and MSRB Rule G19, Suitability of Transactions. Professional reasoning. Professionals should employ a structured decision-making framework that prioritizes client needs and regulatory compliance. This involves 1. Understanding the client, thoroughly assessing the client's financial situation, investment objectives, and risk tolerance. 2. Due diligence, conducting comprehensive research on the security, including its issuer, structure, credit quality, and market conditions. 3. Suitability assessment, matching the security's characteristics with the client's profile. 4. Disclosure, providing clear, accurate, and timely information about the investment, including its risks and benefits. 5. Compliance, adhering strictly to all applicable federal, state, and self-regulatory organization rules. Question 6. Cost-benefit analysis shows that a Certificate of Participation (COP) offering in California, backed by lease rental payments for essential public infrastructure, presents a competitive yield. A registered representative is considering recommending this COP to a client. Which approach best reflects the necessary risk assessment and due diligence for this specific municipal security? Option A. Recommend the COP based on its tax-exempt status and the general perception of safety associated with municipal bonds. Option B. Advise the client to invest based on the COP's attractive yield, assuming that municipal lease financings are inherently low risk. Option C. Thoroughly investigate the terms of the lease agreement, the creditworthiness of the municipal obligor, and the specific revenue stream or appropriation that will fund the lease payments, considering any potential for abatement. Option D. Focus on the COP's maturity date and its potential to diversify the client's existing portfolio without delving into the specifics of the lease structure. The correct answer is C. Thoroughly investigate the terms of the lease agreement, the creditworthiness of the municipal obligor, and the specific revenue stream or appropriation that will fund the lease payments, considering any potential for abatement. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to assess the suitability of a certificate of participation, COP, investment for a client, specifically in the context of lease rental financings within the state of California. The complexity arises from the need to understand the underlying revenue stream, the creditworthiness of the obligor, and the potential risks associated with municipal lease financings, all while adhering to FINRA rules and California state regulations regarding municipal securities. A failure to conduct a thorough risk assessment can lead to unsuitable recommendations, regulatory violations, and harm to the client. Correct approach analysis. The best professional practice involves a comprehensive risk assessment that prioritizes understanding the specific revenue source backing the COP and the credit quality of the municipal entity or its designated payment source. This approach aligns with FINRA Rule 2111, Suitability, and the Municipal Securities Rulemaking Board, MSRB, Rule G19, Suitability, which mandate that recommendations be suitable for the customer based on their investment objectives, financial situation, and needs. For lease rental financings, this means scrutinizing the lease agreement, the essentiality of the leased asset, the obligor's history of making lease payments, and any potential for default or abatement of payments. This deep dive into the specific security features and creditworthiness is paramount for California municipal securities. Incorrect approach is analysis. Recommending the COP solely based on its tax-exempt status and a general understanding of municipal bonds would be an insufficient approach. This fails to address the specific risks inherent in lease rental financings, which are not general obligation bonds and are dependent on the obligor's covenant to pay from specific revenues or appropriations, not ad valorem taxes. This overlooks the critical due diligence required by MSRB Rule G8, Books and Records, and G19, suggesting the COP without investigating the underlying lease agreement and the obligor's financial health, relying instead on the perceived safety of municipal investments in general, is also a flawed approach. This demonstrates a lack of diligence and a failure to understand the nuances of COP structures, potentially exposing the client to risks not adequately disclosed or understood. This violates the principle of knowing your customer and the product, a cornerstone of ethical conduct and regulatory compliance. Focusing only on the yield of the COP without a thorough analysis of the underlying security and credit risk is a dangerous practice. While yield is a factor in investment decisions, it cannot be the sole determinant, especially when it may be compensating for higher or undisclosed risks. This approach neglects the fundamental requirement to assess the overall risk profile of the investment in relation to the client's profile, which is a direct contravention of suitability obligations. Professional reasoning. Professionals should adopt a systematic risk assessment framework. This begins with understanding the client's financial profile, investment objectives, and risk tolerance. Subsequently, for any recommended investment, particularly a municipal security like a COP, a deep dive into the specific security structure, the obligor's creditworthiness, the source of repayment, and any potential risks, e.g., abatement clauses, defeasance provisions, call features, is essential. This due diligence must be documented and should inform the suitability determination. When dealing with lease rental financings in California, specific attention must be paid to the terms of the lease agreement and the obligor's capacity to continue making payments, as these are distinct from general obligation bonds. Question 7. Cost-benefit analysis shows that a municipal bond offering in California presents several options for investors. Considering a client with a moderate risk tolerance, which of the following approaches best aligns with the principles of prudent investment recommendation and regulatory compliance? Option A. Recommend special tax bonds based on the general assumption that taxes will always be collected to service the debt. Option B. Prioritize bonds with the strongest security pledges, such as double-barreled bonds, and clearly articulate the varying levels of security among special tax, special assessment, and moral obligation bonds. Option C. Suggests special assessment bonds as a primary option, emphasizing the potential for high returns if the underlying project is successful. Option D. Advise the client that moral obligation bonds are as secure as general obligation bonds due to the issuer's reputation. The correct answer is B. Prioritize bonds with the strongest security pledges, such as double-barreled bonds, and clearly articulate the varying levels of security among special tax, special assessment, and moral obligation bonds. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of different municipal bond structures and their associated risks, particularly when advising a client with a moderate risk tolerance. The challenge lies in accurately assessing the security behind each bond type and aligning that assessment with the client's investment objectives and risk profile, all within the regulatory framework governing municipal securities in California. The best professional approach involves prioritizing the security of principal and interest payments based on the specific revenue streams or pledges backing each bond. This means recognizing that double-barreled bonds, backed by both a specific revenue source and the full faith and credit of the issuer, generally offer a higher level of security than special tax or special assessment bonds, which are solely dependent on a particular revenue stream. Moral obligation bonds, while often considered strong, carry a slightly higher risk as the pledge is not a legally enforceable debt obligation, relying instead on the issuer's willingness to appropriate funds. Therefore, for a client with a moderate risk tolerance, understanding this hierarchy of security is paramount. This approach aligns with the ethical duty to recommend suitable investments and the regulatory requirement to ensure clients understand the risks involved. An incorrect approach would be to recommend special tax bonds without a thorough analysis of the specific tax base and its historical stability. This fails to adequately assess the risk of revenue shortfall, potentially exposing the client to a higher risk than their tolerance allows. Ethically, this is a failure to perform due diligence and recommend suitable investments. Another incorrect approach would be to treat moral obligation bonds as equivalent in security to general obligation bonds. While often well supported, the lack of a direct, legally enforceable pledge introduces a layer of risk that must be clearly communicated and considered against the client's risk tolerance. This misrepresentation of security levels violates the duty of fair dealing and suitability. Finally, recommending special assessment bonds without a detailed understanding of the specific project's success probability and the assessment collection rate would be professionally unsound. These bonds are highly dependent on the success of a particular project and the ability of property owners to pay assessments, making them inherently riskier and potentially unsuitable for a client with moderate risk tolerance. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's financial situation, investment objectives, and risk tolerance. This is followed by a thorough due diligence process for each potential investment, focusing on the specific security features, revenue sources, issuer's financial health, and any relevant legal covenants. For municipal bonds, this includes understanding the distinctions between general obligation, revenue, special tax, special assessment, moral obligation, and double-barreled bonds. The professional must then match the risk profile of the investment to the client's profile, ensuring clear and transparent communication about all associated risks and potential rewards. Question 8. The risk matrix shows a potential for significant price volatility in a municipal bond portfolio due to an upcoming large issuance in the California municipal market. A registered representative is considering executing a forward delivery transaction for a client who has expressed interest in securing a specific bond at a predetermined price for settlement in 3 months. What is the most appropriate course of action for the representative? Option A. Advise the client to postpone any forward delivery commitments until after the large issuance has settled, without explaining the specific risks of the current market environment. Option B. Proceed with the forward delivery transaction as requested, assuming the predetermined price will be honored regardless of market fluctuations, as this is the nature of a forward agreement. Option C. Discuss with the client the potential impact of the large issuance on market prices and the specific risks associated with forward delivery transactions in a volatile environment, ensuring the client understands how these factors could affect the agreed-upon price at settlement. Option D. Execute the forward delivery transaction and inform the client that the predetermined price is guaranteed, downplaying any potential market impact from the upcoming issuance. The correct answer is C. Discuss with the client the potential impact of the large issuance on market prices and the specific risks associated with forward delivery transactions in a volatile environment, ensuring the client understands how these factors could affect the agreed-upon price at settlement. Explanation. The risk matrix shows a potential for significant price volatility in a municipal bond portfolio due to an upcoming large issuance. A registered representative must advise a client on how to manage this risk, particularly concerning forward delivery transactions. The challenge lies in balancing the client's investment objectives with the inherent risks of forward commitments in a fluctuating market, ensuring full disclosure and suitability. The best approach involves proactively discussing the implications of the anticipated large issuance on the client's existing holdings and any potential forward delivery commitments. This includes explaining how market supply and demand dynamics, influenced by the new issuance, could impact the value of bonds purchased or sold for future delivery. The representative should clearly outline the risks associated with forward delivery, such as the possibility of adverse price movements between the agreement date and the settlement date, and how these risks might be amplified by the impending large issuance. This ensures the client is fully informed and can make an educated decision based on their risk tolerance and investment goals, aligning with FINRA Rule 2111 suitability and the Municipal Securities Rulemaking Board, MSRB, Rule G19, investment recommendations. An unacceptable approach would be to proceed with a forward delivery transaction without adequately disclosing the heightened risks posed by the upcoming large issuance. This failure to provide comprehensive information about potential price fluctuations and their impact on the forward commitment violates the duty of fair dealing and suitability. Another unprofessional course of action would be to advise the client to simply ignore the potential impact of the issuance, suggesting that forward delivery agreements are insulated from such market events. This misrepresents the nature of forward contracts and exposes the client to undue risk without proper understanding. Lastly, recommending a forward delivery transaction solely based on the client's past preference for such arrangements, without re-evaluating suitability in light of the new market conditions and the specific risks of the impending issuance, demonstrates a lack of due diligence and a failure to adhere to the ongoing suitability obligation. Professionals should employ a decision-making framework that prioritizes client understanding and risk management. This involves first identifying potential market events that could impact a client's portfolio, then assessing the specific risks of any proposed transaction, especially those involving future commitments. Crucially, all relevant risks must be clearly and comprehensively communicated to the client, allowing them to make an informed decision that aligns with their financial objectives and risk tolerance. Question 9. The audit findings indicate that a municipal securities representative in California, when discussing a new issue of municipal bonds with a client, described the bond's redemption features as the city can pay it back early whenever they want, and you'll get your money back plus a little extra. Which of the following best characterizes the potential misrepresentation and the correct disclosure required under MSRB rules? Option A. The representative accurately described a sinking fund call as the city is systematically retiring its debt. Option B. The representative accurately described an extraordinary call as unforeseen events can lead to early redemption. Option C. The representative failed to accurately distinguish between an optional call and a make-whole call, and should have specified whether the issuer had discretion to call optional and the exact compensation structure if called early, make-whole. Option D. The representative accurately described a mandatory call, as the city has the obligation to redeem the bond on a specific date. The correct answer is C. The representative failed to accurately distinguish between an optional call and a make-whole call, and should have specified whether the issuer had discretion to call optional and the exact compensation structure if called early, make-whole. Explanation. The audit findings indicate a potential misrepresentation of municipal bond features to a client, specifically concerning call provisions. This scenario is professionally challenging because it requires a deep understanding of various call types and their implications for investors, as well as the ethical obligation to provide accurate and complete information. Mischaracterizing these features can lead to significant financial harm for the client and regulatory scrutiny for the representative. The best professional practice involves accurately identifying and explaining the specific call provisions applicable to the municipal security being recommended. This includes understanding that an optional call allows the issuer to redeem the bond before maturity at their discretion, often at a premium, while a sinking fund call is a prearranged redemption of a portion of the outstanding bonds, typically at par or a specified price, to retire debt systematically. An extraordinary call is triggered by unforeseen events, and a make-whole call provides the investor with a predetermined amount of compensation if the bond is called early, effectively making the investor whole. A mandatory call, unlike an optional call, obligates the issuer to redeem the bond on a specific date or series of dates. For our representative in California, adherence to FINRA rules and the Municipal Securities Rulemaking Board (MSRB) rules, particularly those concerning fair dealing and disclosure, is paramount. Providing a clear and precise explanation of the applicable call provision, without oversimplification or omission, ensures the client can make an informed investment decision based on the actual terms of the security. Failing to accurately distinguish between these call types constitutes a significant regulatory and ethical failure. For instance, describing an optional call as a mandatory redemption would mislead the client about the issuer's discretion and the potential for early redemption, impacting their reinvestment risk assessment. Similarly, conflating a sinking fund call with a make-whole call would misrepresent the investor's compensation upon early redemption. Presenting an extraordinary call as a standard feature without detailing the specific triggering events would also be a misrepresentation. Each of these mischaracterizations violates the MSRB Rule G17 on fair dealing with customers, which mandates that brokers, dealers, and municipal securities dealers treat customers fairly and provide them with all material information. Professionals should adopt a decision-making framework that prioritizes accurate disclosure and client understanding. This involves thoroughly researching the specific terms and conditions of any municipal security, including all call provisions, before discussing it with a client. When presenting information, representatives should use clear, unambiguous language and be prepared to explain the nuances of each feature. If unsure about a specific provision, they should consult with a supervisor or research department rather than making assumptions or providing potentially misleading information. The ultimate goal is to empower the client with the knowledge necessary to assess the risks and rewards of an investment. Question 10. Stakeholder feedback indicates a municipality in California is considering issuing general obligation bonds to fund infrastructure improvements. The proposed bond measure is expected to be on the ballot during a general election where historical turnout is 60% of registered voters. If 70% of the voters who cast ballots on the bond measure vote in favor, what is the approximate percentage of registered voters who must vote in favor for the bond to be approved, given California's constitutional requirements for general obligation bonds? Option A. Approximately 35% of registered voters must vote in favor. Option B. Approximately 40% of registered voters must vote in favor. Option C. Approximately 46.7% of registered voters must vote in favor. Option D. Approximately 70% of registered voters must vote in favor. The correct answer is C. Approximately 46.7% of registered voters must vote in favor. Explanation. This scenario presents a professional challenge because it requires a municipal securities representative to navigate complex state-specific limitations on bond issuance, specifically concerning voter approval thresholds, while also performing a critical financial calculation. Misinterpreting or misapplying these limitations can lead to incorrect advice, potentially causing significant financial repercussions for the municipality and its investors, and exposing the representative and their firm to regulatory scrutiny. The core of the challenge lies in accurately assessing the feasibility of a proposed bond issuance under the specific legal framework of California. The best professional approach involves a precise calculation of the required voter turnout and the percentage of affirmative votes needed to approve the bond measure, directly referencing the relevant California constitutional provisions. This approach is correct because it adheres strictly to the statutory and constitutional requirements of California law governing municipal bond issuance. Specifically, Article Roman 16, Section 1 of the California Constitution mandates that general obligation bonds require approval by a two-thirds majority of the votes cast by the electors voting on the proposition. This necessitates a precise calculation to determine if the projected voter turnout and approval percentage meet this stringent threshold. An incorrect approach would be to assume that a simple majority of votes cast is sufficient for approval. This fails to acknowledge the specific two-thirds supermajority requirement stipulated by the California Constitution for general obligation bonds, leading to a miscalculation of the approval likelihood. Another incorrect approach would be to disregard the voter turnout entirely and focus solely on the percentage of affirmative votes among those who cast a ballot, without considering the total number of eligible voters or the specific wording of the constitutional requirement. This overlooks the critical element of voter participation as a prerequisite for the validity of the vote. Finally, an approach that relies on general knowledge of bond issuance requirements without consulting the specific California constitutional provisions would be fundamentally flawed, as it ignores the unique and stringent legal framework applicable to the state. Professionals should employ a decision-making framework that prioritizes thorough research of the specific jurisdiction's laws and regulations, followed by meticulous calculation based on those requirements. This involves understanding the nuances of voter approval thresholds, distinguishing between different types of bonds, e.g., general obligation vs. revenue bonds, though this question focuses on a scenario where voter approval is a factor, and ensuring all calculations are performed with absolute accuracy against the backdrop of the governing legal framework. Question 11. System analysis indicates that a municipal securities representative in California is advising a client on a potential investment in a new municipal bond issuance by a public university to finance the construction of new dormitory facilities. The representative has reviewed the preliminary official statement. Which of the following represents the most prudent and compliant course of action? Option A. Advise the client that bonds issued by public universities are inherently low-risk investments and therefore suitable for most investors without further detailed analysis. Option B. Rely primarily on the bond rating agency's assessment of the issuance, assuming their evaluation adequately covers the investment's risks. Option C. Highlight the tax advantages and potential yield of the bond, while downplaying or omitting detailed discussion of the university's financial performance and dormitory occupancy projections. Option D. Thoroughly review the official statement and any supplemental disclosure documents to understand the bond's security, the university's financial health, projected dormitory revenue, and associated risks. Then assess the suitability for the client and clearly communicate all relevant information. The correct answer is D. Thoroughly review the official statement and any supplemental disclosure documents to understand the bond's security, the university's financial health, projected dormitory revenue, and associated risks. Then assess the suitability for the client and clearly communicate all relevant information. Explanation. Scenario analysis. This scenario presents a professional challenge for a municipal securities representative in California because it involves advising a client on a complex municipal bond offering for a public university's dormitory expansion. The representative must navigate the specific disclosure requirements and suitability standards applicable to California municipal securities, ensuring the client receives accurate and complete information relevant to their investment objectives and risk tolerance. The challenge lies in synthesizing technical information about the bond's security, revenue sources, and potential risks into understandable terms for the client, while adhering strictly to FINRA rules and California state regulations governing municipal securities sales. Correct approach analysis. The best professional practice involves a thorough review of the official statement and any supplemental disclosure documents provided by the issuer. This includes understanding the bond structure, the university's financial health, the projected revenue streams from dormitory occupancy, and any covenants or limitations associated with the bonds. The representative must then assess the suitability of this investment for the client by considering their financial situation, investment goals, and risk tolerance. Finally, they must clearly communicate all relevant information, including potential risks and benefits, to the client, ensuring the client can make an informed investment decision. This approach aligns with FINRA Rule 2110, Standards of Commercial Honor and Principles of Trade, and FINRA Rule 2121, fair prices and commissions, by promoting fair dealing and ensuring suitability, and it respects the disclosure obligations under the Securities Act of 1933 and MSRB Rule G17, disclosure of material information. Incorrect approaches analysis, relying solely on the bond rating agency's opinion without independently verifying the underlying security and revenue sources is a regulatory failure. While ratings provide a general indication of creditworthiness, they do not substitute for the representative's duty to understand the specifics of the offering and its suitability for the client. This approach risks misrepresenting the investment's true risk profile and violates the principle of due diligence. Presenting only the potential yield and tax benefits without discussing the underlying security, the university's financial stability, or potential risks associated with dormitory occupancy rates would be a significant ethical and regulatory breach. This selective disclosure misleads the client and fails to meet the suitability requirements mandated by FINRA and MSRB rules, which require a full and fair disclosure of all material facts. Recommending the bond based on the fact that it is a safe investment because it is issued by a public university, without conducting a detailed analysis of the specific revenue streams and potential vulnerabilities of the dormitory project, is also professionally unacceptable. This generalization ignores the nuances of municipal finance and the specific risks associated with revenue bonds, which are directly tied to the operational success of the finance project. It fails to meet the standard of care expected of a securities professional. Professional reasoning. Professionals should adopt a systematic approach to client advisory. This involves 1. Understanding the product, thoroughly reviewing all offering documents and understanding the issuer's financial condition and the bond's security. 2. Understanding the client, assessing the client's financial profile, investment objectives, and risk tolerance. 3. Matching product to client, determining if the investment is suitable based on the information gathered in steps 1 and 2. 4. Clear communication, disclosing all material information, including risks and benefits, in a manner the client can understand. This framework ensures compliance with regulatory obligations and upholds ethical standards. Question 12. Strategic planning requires a municipal securities representative in California to assess a client's investment profile. The client has explicitly stated a primary objective of capital preservation and a need for immediate liquidity. Considering the characteristics of various municipal debt instruments, which of the following would be the most appropriate recommendation for this client? Option A. A variable rate demand obligation VRDO with a remarketing agent and a bank letter of credit. Option B. A multimodal municipal bond with a long-term fixed interest rate period. Option C. A grant anticipation note GAN issued by a municipality for an upcoming infrastructure project. Option D. A construction loan note CLN used to finance a new public facility. Correct answer is A. A variable rate demand obligation VRDO with a remarketing agent and a bank letter of credit. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a municipal securities representative to navigate the complexities of different municipal debt instruments, specifically focusing on their suitability for a client with a stated investment objective. The representative must understand the unique characteristics of variable rate demand obligations, VRDO, multimodal bonds, grant anticipation notes, GAN, and construction loan notes, CLN, to recommend the most appropriate option. Misunderstanding or misrepresenting the features of these instruments can lead to significant financial detriment for the client and regulatory violations for the representative. The core challenge lies in aligning the client's need for liquidity and capital preservation with the risk-return profiles of these varied municipal securities. Correct approach analysis. The best professional practice involves thoroughly understanding the client's stated investment objective of capital preservation and immediate liquidity needs. A variable rate demand obligation, VRDO, is the most suitable instrument in this context. VRDO are municipal securities with interest rates that reset periodically, and they are typically supported by a bank letter of credit or other credit enhancement, providing holders with the option to tender the bonds back to the issuer or remarketing agent at par value on specified dates. This feature directly addresses the client's need for immediate liquidity and capital preservation, as the ability to redeem the bond at par minimizes interest rate risk and provides access to funds when needed. FINRA Rule 2111. Suitability. mandates that recommendations must be suitable for the customer based on their investment objectives, risk tolerance, and financial situation. Recommending a VRDO directly aligns with the client's stated requirements. Incorrect approaches analysis. Recommending a grant anticipation note, GAN, would be inappropriate because GANs are short-term notes issued in anticipation of federal or state grant funds. While they offer relatively high liquidity due to their short maturities, their primary purpose is to finance specific projects, and their repayment is contingent on the receipt of grant funds, which introduces a degree of credit risk and a different liquidity profile than immediate access to capital at par. This does not align with the client's primary need for capital preservation and immediate liquidity. Suggesting a construction loan note, CLN, would also be unsuitable. CLNs are typically used to finance construction projects and often carry higher risks, including construction delays, cost overruns, and potential default. Their liquidity can be limited, and their principal repayment is tied to the successful completion and sale of the financed project, which is contrary to the client's objective of capital preservation and immediate liquidity. Proposing a multimodal bond without further clarification of its specific features would be a failure to adequately assess suitability. While multimodal implies flexibility, it does not inherently guarantee the immediate liquidity and capital preservation the client requires. The representative would need to ascertain if the specific multimodal structure includes features like a demand feature or a short reset period that would satisfy the client's stated needs. Without this specific understanding, it is a speculative recommendation. Professional reasoning. Professionals should employ a structured approach to client recommendations. First, meticulously identify and document the client's investment objectives, risk tolerance, and liquidity needs. Second, gain a comprehensive understanding of the features, risks, and benefits of all available investment products, including their regulatory implications. Third, match the client's profile to the product that best satisfies their stated requirements, prioritizing instruments that offer the highest degree of alignment. Fourth, clearly communicate the rationale for the recommendation to the client, ensuring they understand how the proposed investment meets their specific needs and any associated risks. This systematic process, grounded in regulatory obligations like FINRA suitability rule, ensures that recommendations are not only compliant but also ethically sound and in the client's best interest. Question 13. Strategic planning requires a registered representative in New York to advise a client on municipal securities. The client is seeking a short-term investment with tax advantages. The representative is considering recommending Revenue Anticipation Notes, RAN, or Bond Anticipation Notes, BAN. Which of the following represents the most prudent approach? Option A. Conduct a thorough suitability assessment of the client's financial situation, investment objectives, and risk tolerance before recommending either RANs or BANs, ensuring the client understands the specific risks associated with each, including the reliance on anticipated revenues for RANs and the purpose of the underlying bond issuance for BANs. Option B. Advise the client to invest in Bond Anticipation Notes, BAN, because they are backed by the eventual issuance of long-term bonds, implying a higher degree of security than RANs, irrespective of the client's investment horizon or liquidity requirements. Option C. Recommend Revenue Anticipation Notes, RAN, due to their generally lower interest rates compared to other short-term municipal debt, without further inquiry into the client's specific financial needs or risk profile. Option D. Suggest Variable Rate Demand Obligations, VRDO, as a superior alternative to anticipation notes, emphasizing their liquidity features, without first determining if the client's investment objectives align with the characteristics of VRDO. The correct answer is A. Conduct a thorough suitability assessment of the client's financial situation, investment objectives, and risk tolerance before recommending either RANs or BANs, ensuring the client understands the specific risks associated with each, including the reliance on anticipated revenues for RANs and the purpose of the underlying bond issuance for BANs. Explanation. Strategic planning requires a thorough understanding of municipal finance instruments and their implications for investors. In the context of the Series 52 exam, particularly concerning anticipation notes, a key challenge for a registered representative is to accurately assess the suitability of these instruments for different client profiles, considering their inherent risks and the specific regulatory environment of New York. The best professional practice involves a comprehensive evaluation of the client's financial situation, investment objectives, and risk tolerance before recommending any municipal security, including anticipation notes. This approach aligns with FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe a recommended transaction or investment strategy is suitable for a particular customer, based on the information obtained through reasonable diligence. For anticipation notes, this means understanding that, while they are generally considered short-term and relatively safe, their repayment is contingent on the anticipated revenues, which can be subject to economic fluctuations or unexpected shortfalls. A representative must ensure the client understands this risk and that the investment fits within their broader financial plan. Recommending anticipation notes solely based on their tax-exempt status, without a detailed client suitability assessment, is a significant regulatory failure. This overlooks the fundamental obligation to act in the client's best interest and could lead to an unsuitable investment, violating FINRA Rule 2111. Similarly, focusing only on the short-term nature of anticipation notes while ignoring the underlying revenue source and the client's liquidity needs is also problematic. The short-term aspect does not inherently guarantee suitability if the client requires immediate access to funds or if the revenue stream supporting the note is precarious. Finally, suggesting anticipation notes as a guaranteed safe haven without disclosing the potential risks associated with revenue shortfalls or the issuer's financial health constitutes a misrepresentation and a failure to provide adequate information, which is a breach of ethical conduct and regulatory requirements. Professionals should employ a structured decision-making process that begins with gathering detailed client information, followed by a thorough analysis of the investment product's characteristics and risks, and finally, a careful matching of the product to the client's profile. This process ensures that recommendations are not only compliant but also ethically sound and in the client's best interest. Question 14. The control framework reveals that a client in California has expressed a strong desire to liquidate a municipal bond holding to access immediate funds. As a registered representative, what is the most prudent course of action to ensure compliance with FINRA and MSRB regulations regarding early redemption? Option A. Thoroughly review the municipal bond's official statement and any supplemental indentures to ascertain the specific terms and conditions of any call provisions, including any associated premiums or penalties, and then clearly communicate these findings to the client before proceeding. Option B. Focus solely on the current market price of the municipal bond to determine its liquidation value, without considering the issuer's potential to call the bond early. Option C. Advise the client to redeem the security immediately based on their stated need for funds, assuming that early redemption is generally beneficial for clients seeking liquidity. Option D. Proceed with the redemption without investigating the bond's specific call provisions, assuming that most municipal bonds do not have significant penalties for early redemption. The correct answer is A. Thoroughly review the municipal bond's official statement and any supplemental indentures to ascertain the specific terms and conditions of any call provisions, including any associated premiums or penalties, and then clearly communicate these findings to the client before proceeding. Explanation. The control framework reveals a scenario where a registered representative must navigate the complexities of early redemption of municipal securities for a client in California. This situation is professionally challenging because it requires balancing the client's immediate financial needs with the potential financial implications of early redemption, such as call provisions and associated penalties, all while adhering to FINRA rules and California state regulations governing municipal securities. A thorough understanding of the securities terms and the regulatory landscape is paramount to providing sound advice. The best professional approach involves a comprehensive review of the specific municipal bonds offering documents, including the official statement and any supplemental indentures, to identify the exact terms and conditions related to early redemption. This includes scrutinizing call provisions, any applicable call protection periods, and potential redemption premiums or penalties. The representative must then clearly communicate these findings to the client, explaining the financial impact of redeeming the security before its maturity date, including any loss of future interest payments or incurred costs. This approach is correct because it prioritizes informed decision-making based on the specific security's contractual terms and regulatory requirements, ensuring the client understands all consequences before proceeding. This aligns with FINRA Rule 2111, Suitability, and the Municipal Securities Rulemaking Board, MSRB, Rule G17, Fair Dealing with Customers, which mandate that representatives deal fairly with customers and provide them with information necessary to make informed investment decisions. An incorrect approach would be to advise the client to redeem the security based solely on the client's stated desire for immediate funds, without first investigating the redemption terms. This fails to uphold the duty of suitability and fair dealing, as it neglects to inform the client of potential financial detriments like redemption penalties or the loss of future interest, which could be substantial. Another incorrect approach would be to assume that all early redemptions are penalty-free and proceed with the transaction without verifying the specific bond's call provisions. This demonstrates a lack of due diligence and a failure to adhere to the specific terms of the security, potentially exposing the client to unexpected costs and violating MSRB Rule G17's requirement to disclose material facts. Finally, an incorrect approach would be to only consider the current market value of the bond, without factoring in the issuer's right to call the security. While market value is a consideration, the issuer's call option is a critical contractual right that directly impacts the feasibility and financial outcome of an early redemption, and ignoring it constitutes a significant oversight. Professionals should employ a systematic decision-making process. First, identify the client's objective. Second, thoroughly research the specific securities features, including all call provisions and associated costs. Third, analyze the financial implications of the client's objective in light of the securities features. Fourth, clearly communicate all findings and potential outcomes to the client. And fifth, act in accordance with the client's informed decision, ensuring all regulatory requirements are met. Question 15. Market research demonstrates that a client in California is seeking an investment that offers the potential for significant capital growth over a long-term horizon, with no immediate need for income. They are particularly interested in municipal bonds due to potential tax advantages. Which of the following approaches best addresses the client's stated objectives and regulatory requirements? Option A. Explain the nature of capital appreciation bonds, zeros, detailing their issuance at a discount and the realization of return at maturity without periodic interest payments. Option B. Suggest a fixed-rate municipal bond, emphasizing its predictable coupon payments and stability. Option C. Recommend a variable/floating rate municipal bond, highlighting its potential to adjust to market interest rate changes. Option D. Describe a capital appreciation bond as a method to secure a guaranteed future sum without elaborating on its zero coupon structure or lack of interim interest. The correct answer is A. Explain the nature of capital appreciation bonds, zeros, detailing their issuance at a discount and the realization of return at maturity without periodic interest payments. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to understand the nuances of different municipal bond structures and their implications for investors, particularly concerning interest rate risk and potential for capital appreciation, while adhering to the suitability requirements under FINRA rules for the state of California. Misunderstanding these characteristics can lead to recommending unsuitable investments, violating regulatory obligations. Correct approach analysis. The best professional practice involves accurately describing the characteristics of a capital appreciation bond, CAB, also known as a zero-coupon municipal bond, to the client. This includes explaining that CABs are issued at a deep discount to their face value and do not pay periodic interest. The investor's return is realized at maturity when the bond pays its full face value. This approach is correct because it provides the client with a clear and truthful understanding of the investment structure, its lack of current income, and its primary mechanism for generating return, aligning with the suitability rules mandate to ensure recommendations are appropriate for the customer's investment objectives, risk tolerance, and financial situation. This transparency is crucial for informed decision-making. Incorrect approaches analysis. Recommending a variable/floating rate municipal bond without fully explaining its fluctuating interest payments and potential for principal volatility would be an ethical and regulatory failure. While it offers potential benefits in a rising rate environment, its unpredictability might not align with a client seeking stable income or capital preservation, and failing to disclose this uncertainty violates the duty of fair dealing. Suggesting a fixed-rate municipal bond as a primary option without acknowledging the client's stated interest in potential capital appreciation would be a misstep. While fixed-rate bonds provide predictable income, they do not inherently offer the capital appreciation potential that a CAB does, and overlooking a client's expressed objective is a breach of suitability. Describing a capital appreciation bond solely as a way to lock in a future payout, without detailing its zero-coupon nature and the absence of interim interest payments is misleading. This incomplete description fails to convey the full picture of the investment, including its sensitivity to interest rate changes prior to maturity, and the fact that the entire return is realized at the end, potentially leading the client to have unrealistic expectations about the investment's performance or liquidity. Professional reasoning. Professionals should always prioritize a thorough understanding of the client's financial profile, investment objectives, and risk tolerance. When discussing municipal securities, it is imperative to accurately and comprehensively explain the specific characteristics of each bond type, including its coupon structure, fixed, variable, or zero coupon, payment schedule, and how returns are generated. This ensures that recommendations are not only compliant with FINRA rules regarding suitability, but also ethically sound, fostering trust and enabling clients to make well-informed investment decisions. Question 16. Governance review demonstrates that a municipal securities representative in California is advising a client who requires short-term liquidity to manage seasonal cash flow fluctuations in their business operations. The representative is considering recommending a tax anticipation note, TAN. Which of the following best describes the critical understanding required to appropriately advise the client on this type of security? Option A. The representative must understand that TANs are suitable for clients seeking to invest funds for periods longer than 1 year, as they provide a stable, albeit short-term, return. Option B. The representative must understand that TANs are issued in anticipation of receiving specific tax revenues and are primarily used to manage short-term cash flow needs related to those expected revenues. Option C. The representative must understand that TANs carry the same security and risk profile as a general obligation bond, as they are both direct obligations of the municipality. Option D. The representative must understand that TANs are short-term debt instruments and can be recommended for any client needing quick access to funds, regardless of the specific revenue source. The correct answer is B. The representative must understand that TANs are issued in anticipation of receiving specific tax revenues and are primarily used to manage short-term cash flow needs related to those expected revenues. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities representative to understand the nuances of different short-term municipal debt instruments and their suitability for a client with specific liquidity needs. Mischaracterizing the nature of these instruments can lead to inappropriate recommendations, potentially exposing the client to undue risk or failing to meet their investment objectives, which is a direct violation of suitability obligations under FINRA rules governing municipal securities. Correct approach analysis. The best professional practice involves accurately distinguishing between tax anticipation notes, TAN, and bond anticipation notes, BAN, based on their underlying security and purpose. TANs are issued in anticipation of collecting anticipated tax revenues, typically for general fund operations, and are secured by those expected tax receipts. BAN, on the other hand, are issued in anticipation of a future bond issuance, with the expectation that the proceeds from the long-term bonds will be used to repay the BANs. Therefore, understanding that TANs are secured by expected tax revenues and are generally used for short-term cash flow needs, while BANs are a bridge to long-term debt, is crucial for proper client suitability. This approach aligns with the regulatory requirement to recommend investments that are suitable for the customer's financial situation and investment objectives. Incorrect approach is analysis. Recommending a TAN to a client solely because it is a short-term debt instrument without considering its specific security, anticipated tax revenues, and typical use, general fund operations, is an incomplete analysis. This approach fails to fully grasp the underlying security and purpose of the note, potentially leading to a mismatch with client needs if those needs are not directly related to general fund cash flow. Suggesting that a TAN is a direct obligation of the municipality's full faith and credit, similar to a general obligation bond, is factually incorrect and misleading. TANs are secured by specific anticipated revenues, not the general taxing power of the municipality in the same way as a GO bond. Equating the risk and security profile of a TAN to that of a general obligation bond is a significant misrepresentation. Presenting a TAN as a long-term investment option is fundamentally wrong, as TANs are inherently short-term instruments designed to manage temporary cash flow deficits and are repaid from specific revenue streams within a fiscal year. Professional reasoning. Professionals should approach client recommendations by first thoroughly understanding the client's financial profile, investment objectives, and liquidity needs. Subsequently, they must possess a deep and accurate understanding of the specific characteristics of any proposed investment, including its security, purpose, maturity, and risk profile. When evaluating short-term municipal debt like TANs and BANs, the focus must be on their distinct features. TANs are backed by anticipated tax revenues for general operations, while BANs are a precursor to long-term bond financing. This detailed understanding allows for a precise match between client requirements and investment attributes, fulfilling suitability obligations. Question 17. Governance review demonstrates that a registered representative in California, when discussing a new issue of tax-exempt commercial paper with a client, stated that the paper was fully tax-exempt and would provide a reliable short-term investment. The representative did not mention any potential restrictions on arbitrage yield. Which of the following best describes the representative's conduct in relation to MSRB rules concerning disclosure for municipal securities? Option A. The representative's assurance of fully tax-exempt status was appropriate given the short-term nature of commercial paper. Option B. The representative fulfilled their duty by implicitly suggesting the client should consider tax implications without explicit disclosure of arbitrage. Option C. The representative should have disclosed that the tax-exempt commercial paper may be subject to arbitrage yield restrictions. Option D. The representative correctly focused on the short-term nature of the paper and the unlikelihood of arbitrage. The correct answer is C. The representative should have disclosed that the tax-exempt commercial paper may be subject to arbitrage yield restrictions. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to navigate the complexities of tax-exempt commercial paper, specifically concerning its potential for arbitrage and the associated disclosure obligations under the Municipal Securities Rulemaking Board (MSRB) rules, which are applicable in the United States. Misunderstanding or misrepresenting the tax-exempt status and potential arbitrage yield of such instruments can lead to significant regulatory violations and client harm. Careful judgment is required to ensure compliance with disclosure requirements and to act in the client's best interest. Correct approach analysis. The best professional practice involves accurately and comprehensively disclosing to the client that the tax-exempt commercial paper may be subject to arbitrage yield restrictions. This approach correctly identifies the potential for arbitrage, which is a key consideration for tax-exempt municipal securities. The MSRB rules, particularly those related to disclosure and fair dealing, mandate that representatives provide clients with all material information necessary to make informed investment decisions. This includes explaining any limitations or potential complications associated with the tax-exempt status, such as arbitrage restrictions that could impact the net yield or tax treatment. By proactively informing the client about these potential issues, the representative upholds their duty of care and ensures transparency. Incorrect approaches analysis. One incorrect approach involves stating that the commercial paper is fully tax-exempt without any further qualification. This is a failure to disclose material information. While the interest income may be exempt from federal income tax, the MSRB rules and general principles of fair dealing require disclosure of any factors that could affect the investment's overall suitability or yield, including potential arbitrage yield restrictions that could impact its tax-exempt status or net return. Another incorrect approach is to focus solely on the short-term nature of the paper and assure the client that arbitrage is unlikely. This is a flawed assumption and a failure to conduct due diligence. Arbitrage is a complex concept that can arise even in short-term instruments under specific market conditions and regulatory definitions. A representative must understand and be able to explain these potential issues, rather than making broad, unsubstantiated assurances. A third incorrect approach is to suggest that the client should consult a tax advisor without providing any initial information about potential arbitrage. While consulting a tax advisor is often prudent, the registered representative still has an independent obligation to provide accurate and complete information about the investment product itself, including any known or potential complexities related to its tax-exempt status. Failing to do so before referring the client to a tax advisor is a dereliction of the representative's duty. Professional reasoning. Professionals should approach situations involving tax-exempt municipal securities by first understanding the specific characteristics of the instrument, including its issuer, maturity, and any potential regulatory restrictions. They must then evaluate how these characteristics might impact the client's investment objectives and tax situation. A critical step is to identify and be prepared to explain any potential issues, such as arbitrage yield restrictions, that could affect the security's tax-exempt status or overall return. Transparency and comprehensive disclosure are paramount. If a client's tax situation is complex, a referral to a qualified tax professional is appropriate, but only after the representative has provided all relevant information about the investment itself. Question 18. The performance metrics show a significant increase in municipal bond trading volume in Ontario, prompting a client to inquire about the ownership structure of their recent municipal bond purchase, which they understand to be a book entry-only issue. How should a registered representative in Ontario best explain the nature of this ownership to the client? Option A. Explain that book entry-only securities are held electronically by a depository and are not represented by physical certificates. Option B. Advise the client that book entry-only securities are the same as bearer bonds and require physical possession for ownership. Option C. Inform the client that book entry-only securities require the client to obtain physical certificates from the depository. Option D. State that book entry-only securities are only suitable for institutional investors and not for individual retail clients in Ontario. The correct answer is A. Explain that book entry-only securities are held electronically by a depository and are not represented by physical certificates. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities representative to understand and apply the nuances of different ownership forms for municipal securities, specifically distinguishing between fully registered and book entry only. Misinterpreting these forms can lead to incorrect advice, operational errors, and potential regulatory violations, impacting client trust and the firm's compliance standing. The challenge lies in accurately advising a client based on their specific needs and understanding the implications of each ownership type within the regulatory framework of Ontario, Canada. Correct approach analysis. The best professional practice involves clearly explaining to the client that book entry-only securities are held electronically by a depository and are not represented by physical certificates. This approach is correct because it accurately reflects the nature of book entry ownership, which is the prevalent form for most modern municipal securities in Ontario. It directly addresses the client's inquiry by defining the ownership type and its practical implications, aligning with the regulatory expectation for representatives to provide clear and accurate information about the securities they handle. This ensures the client understands how their investment is held and managed, promoting informed decision-making. Incorrect approaches analysis. Advising the client that book entry-only securities are the same as bearer bonds is incorrect and a significant regulatory failure. Bearer bonds are no longer issued and are not held electronically. They are owned by whoever physically possesses them. This misrepresentation demonstrates a fundamental misunderstanding of modern securities ownership and could lead to severe client confusion and potential financial loss if the client acts on this misinformation. Suggesting that book entry-only securities require the client to obtain physical certificates from the depository is also incorrect. The defining characteristic of book entry is the absence of physical certificates. This approach fails to grasp the core concept of book entry ownership and would mislead the client into pursuing an impossible action, undermining their confidence and potentially causing them unnecessary effort and expense. Stating that book entry-only securities are only suitable for institutional investors and not for individual retail clients in Ontario is factually incorrect and ethically problematic. While institutional investors are major holders, book entry securities are the standard for most municipal debt, accessible to all types of investors. This advice is not only inaccurate but also potentially discriminatory, limiting a client's investment options based on false pretenses. Professional reasoning. Professionals should approach client inquiries about security ownership by first identifying the specific type of security and its jurisdiction. In Ontario, understanding that most municipal securities are now issued in book entry form is crucial. The representative must then clearly and accurately explain the characteristics of book entry ownership, contrasting it with other forms if necessary, to ensure the client has a complete and correct understanding. This involves staying current with market practices and regulatory guidance regarding securities issuance and ownership. Question 19. Benchmark analysis indicates that a client in California who has expressed a desire for investments that can provide a steady income stream, but is not particularly concerned about tax implications due to their current low tax bracket, is considering taxable municipal bonds. As a registered representative advising this client, which of the following actions best aligns with regulatory requirements and professional ethics when discussing options like Build America bonds, BAB, and other taxable municipal debt? Option A. Recommend taxable municipal bonds, including BABs, primarily because they offer higher coupon rates compared to traditional tax-exempt municipal bonds, assuming the client's low tax bracket makes tax exemption less critical. Option B. Conduct a thorough assessment of the client's overall financial situation, investment objectives, and risk tolerance, and then explain the characteristics of taxable municipal securities, including BABs, focusing on their taxable interest, potential yield advantages, and associated credit risks, to determine suitability. Option C. Suggest that the client invest in taxable municipal bonds because they are generally considered safer than corporate bonds, without delving into the specific credit quality of the proposed municipal issues or the client's individual risk tolerance. Option D. Advise the client that Build America bonds, BAB, are an excellent choice due to the federal subsidy, without detailing the taxable nature of the interest income or the underlying credit risk of the issuer. The correct answer is B. Conduct a thorough assessment of the client's overall financial situation, investment objectives, and risk tolerance, and then explain the characteristics of taxable municipal securities, including BABs, focusing on their taxable interest, potential yield advantages, and associated credit risks, to determine suitability. Explanation. Scenario analysis. This scenario presents a professional challenge for a registered representative advising a client on municipal securities. The challenge lies in accurately assessing the client's investment objectives and risk tolerance, and then aligning those with the specific characteristics of taxable municipal securities, such as Build America bonds, BAB, and other taxable municipal debt. Misunderstanding or misrepresenting these instruments can lead to unsuitable recommendations, regulatory violations, and client dissatisfaction. Careful judgment is required to ensure the client's best interests are prioritized. Correct approach analysis. The best professional practice involves a thorough understanding of the client's financial situation, investment objectives, and risk tolerance before recommending any security. This includes educating the client about the nature of taxable municipal securities, such as BABs, highlighting their taxable interest income, potential for higher yields compared to tax-exempt municipal bonds, and their specific credit risks. The representative must then determine if these characteristics align with the client's stated goals and capacity for risk. This approach ensures that the recommendation is suitable and compliant with FINRA rules regarding suitability and fair dealing. Incorrect approach is analysis. Recommending taxable municipal bonds solely because they offer higher yields than traditional tax-exempt municipal bonds, without a comprehensive assessment of the client's tax situation and overall investment strategy, is a regulatory failure. This approach prioritizes a single characteristic, yield, over the client's holistic needs and can lead to an unsuitable recommendation, particularly if the client does not benefit from the taxable interest income or if the associated risks are not adequately understood. Suggesting Build America bonds, BAB, to a client who has expressed a strong preference for tax-exempt income, without clearly explaining that BABs are taxable, constitutes a misrepresentation and a failure to deal fairly. This directly contradicts the client's stated objective and violates the duty to provide accurate and complete information. Focusing only on the federal subsidy aspect of BABs and downplaying the underlying credit risk of the issuing municipality is also a significant ethical and regulatory failure. While the subsidy is a feature, the primary investment risk remains the issuer's ability to repay the debt. Failing to disclose this adequately can lead to a client making an investment based on incomplete or misleading information. Professional reasoning. Professionals should employ a client-centric decision-making framework. This begins with a deep discovery process to understand the client's financial profile, including their tax bracket, investment horizon, liquidity needs, and risk appetite. Following this, the representative must possess a thorough knowledge of the investment products being considered, including their features, benefits, risks, and regulatory implications. Recommendations should then be directly linked to the client's profile and objectives, with clear and transparent disclosure of all relevant information. A continuous process of monitoring and review ensures that the investment remains suitable over time. Question 20. Operational review demonstrates that the City of Springfield is considering issuing $50 million in general obligation bonds to fund a new infrastructure project. The proposed bonds will have a coupon rate of 4.5% and a maturity of 20 years. Underwriting fees and issuance costs are estimated to be 1.5% of the par value. Potential investor is considering purchasing these bonds and is in a 30% federal and state marginal tax bracket. What is the approximate net cost of issuance for the City of Springfield, and what is the approximate after-tax yield for the investor? Option A. The net cost of issuance for the City of Springfield is approximately 4.50%, and the approximate after-tax yield for the investor is 4.50%. Option B. The net cost of issuance for the City of Springfield is approximately 4.59%, and the approximate after-tax yield for the investor is 3.15%. Option C. The net cost of issuance for the City of Springfield is approximately 4.50%, and the approximate after-tax yield for the investor is 3.15%. Option D. The net cost of issuance for the City of Springfield is approximately 4.59%, and the approximate after-tax yield for the investor is 4.50%. The correct answer is B. The net cost of issuance for the City of Springfield is approximately 4.59%, and the approximate after-tax yield for the investor is 3.15%. Explanation. This scenario presents a professional challenge because it requires an understanding of how municipal bond issuance impacts both the issuer and potential investors, specifically through the lens of financial cost and benefit. A financial advisor must accurately assess these impacts to provide sound advice. The challenge lies in quantifying these advantages and disadvantages, particularly when dealing with different financing structures and their associated costs. The best professional practice involves calculating the true cost of issuance for the municipality, considering all relevant expenses, and comparing this to the potential savings or benefits realized by the investor. This approach is correct because it directly addresses the core financial implications for both parties, aligning with the principles of fair dealing and suitability required under FINRA regulations for municipal securities. Specifically, understanding the issuer's cost of capital and the investor's yield to maturity, net of issuance costs, provides a transparent and quantifiable basis for decision-making. An incorrect approach would be to focus solely on the stated interest rate of the bond, without accounting for the associated issuance costs. This fails to provide a complete picture of the issuer's true borrowing cost and the investor's actual return, potentially leading to misinformed decisions. It violates the duty of care owed to both the issuer and the investor by presenting an incomplete financial analysis. Another incorrect approach is to prioritize the perceived marketability of a bond issue over its actual financial efficiency. Market demand is a factor. It does not negate the need for a thorough cost-benefit analysis. Focusing on market perception without rigorous financial due diligence can lead to suboptimal financing decisions for the issuer and potentially less attractive investments for investors. A third incorrect approach is to solely consider the tax advantages for investors without a corresponding analysis of the issuer's financial burden. While tax benefits are a significant advantage for investors, they do not offset high issuance costs or unfavorable terms for the municipality. This one-sided analysis neglects the issuer's perspective and the overall financial health of the municipal project. The professional reasoning framework for such situations involves a multifaceted impact assessment. First, quantify the issuer's total cost of issuance, including underwriting fees, legal expenses, and any other direct costs. Second, determine the net proceeds received by the issuer. Third, calculate the investor's yield to maturity, considering the purchase price and any accrued interest. Fourth, analyze the tax implications for both parties. Finally, compare these financial metrics to alternative financing options or investment opportunities to ensure the most advantageous outcome for all stakeholders, adhering to regulatory requirements for suitability and fair dealing.